Welcome everyone, and thank you for joining us for What You Need to Know About New IRS Letters 226J for the 2016 tax year. Sponsored by First Capital Consulting and presented by Joanna Kim Brunetti. This webcast has been pre-approved for HRCI and SHRM credits. Please be sure to attend the complete webcast in order to receive your credits. If you have any questions during the webcast, please click on the Q&A tab on your webinar control panel and type them in there. A new tab will open in your browser with the webcast survey. Please make sure to complete it as soon as the webcast is ended. And it's my pleasure now to turn you over to today's presenter.
Good morning or good afternoon, depending on where you are. My name is Joanna Kim Brunetti. I am the VP of Regulatory Affairs at First Capital Consulting. FCCI is a regulatory technology company focused on workforce data. We've been around for about 20 years, and our expertise in workforce data is a platform that we use to provide help to our clients doing ACA compliance since the inception of the ACA. I am an attorney with about 20 years experience. Formerly a partner with Aiken Gump, and I've been with FCCI for over 5 years. Now, our topic today, talking about the IRS Letter 226J, the basis for that is the employer mandate. So the first question is, well, who does this apply to? And, just very briefly, let me just go over who it applies to. It's basically entities with 50 or more full-time or full-time equivalents employees, and those are referred to as applicable large employers or ALEs. And these ALEs are required to file these 1094, 1095C schedules with the IRS every year. And what those filings entail are reporting monthly snapshots of the reporting of the offer of healthcare coverage provided to an ALE's employees and their dependents. They don't make the appropriate offers of health coverage. The IRS can assess these penalties called employer shared responsibility payments, and that's what the letter 226J is based on. Okay, now these penalties that these employer shared responsibility payments pertain to are what's called A penalties or B penalties. The A penalty is for 2016, the standard is 95% in terms of who it needs to be offered coverage to. So the ALE has to offer basically employer-sponsored coverage to at least 95% of their full-time employees and their dependents. That is what the ACA requires the ALE to do. And if the ALE fails to do that, and at least one full-time employee gets a premium tax credit, bam, you could be subject to the A penalty. And so for the upcoming reporting year, the 2018 year, this amount, which the statute basically has it as $2,000 annualized per month, but based on adjustments that are made annually, the 2018 penalty is on a monthly basis, $193.33 per month. And that penalty is basically multiplied by the total number of full-time employees minus 30. And that 30 is what we like to call freebies. You get your first 30 free. So if you have 100 employees and you failed to do that 95% offer of coverage, you would multiply the 100 full-time employees minus 30, so you get 70. And if that's for all 12 months, you multiply by that 2,320 number. So that could be a big number. Now, there's also the B penalty, and that's assessed on a per employee who obtains a premium tax credit. And the B penalty, it's a larger amount on a monthly basis. And for 2018, that's $290 per month that a full-time employee gets a PTC month. So the other thing to note is that the A penalty is the cap on the B penalty. In other words, on a monthly basis, if you as an employer are potentially assessed an A and B penalty, you won't get penalized for more than the total amount for the month for that a penalty. So it's basically a count. So these are basically substantive penalties for failing to offer coverage at 95% and triggered by those full-time employees who get a PTC. This is very different from the 6721, 6722 penalties, which are filing penalties. These are penalties for not complying with the filing rules. And the filing rules are basically to file it on time and to file them completely and accurately, and also to furnish them to the employees. So, regardless of whether the employee met that 95%, somebody got a PTC, if you didn't file these or you filed them incorrectly, you could also be subject to these filing penalties. So you see in the chart there, these penalties can also be pretty big. The sort of general deadline for furnishing is January 31 of the year after the reporting year. And the filing deadline, depending on whether it is for furnishing or for filing, there's that January 31 date for the furnishing, and if you're mailing it versus electronically filing it, they're about a month apart, and it's typically March for the filing deadline. So for the electronic filing deadline. So if you don't comply with those deadlines, or it's not complete or accurate, these are the penalties, and you can see that depending on when it was filed, the penalties will go up dramatically. And then if you don't file it at all, or the IRS has determined that the employer basically willfully didn't file it or did it wrong, those penalties could be up to $530 per return for this year's reporting year. So if you have 100 full-time employees that should have received that 1095-C schedule, or you didn't file it, those 1095 schedules, you multiply that by 100. So 530 times 100, that's a big number. And there's no limit if the IRS, as I mentioned, to determine that there was intentional disregard. Another thing to note is, the ACA came about, on the employer mandate. The first year was 2015, so it's still relatively new. And for the first few years, the IRS has provided what's called transition relief, which is good faith to, basically that you tried to do a good job. So if you made errors or whatever, there is some leniency on that. However, if you didn't file it at all, that good faith relief is just not available. Okay, next slide. Now, there's been, a lot of rumination, particularly in 2017, with the new administration, that the ACA might be going away. But 2017, clearly was an exciting year for the ACA, but it did not go away. And at the end of all that, what we saw was that the individual mandate was zeroed out starting next year. But the employer mandate, which is what we're talking about and what the basis is for the IRS 226J letter, is still the law of the land. And even all of that talk about getting rid of the ACA, they really didn't touch the employer mandate. The employer mandate was just kind of laying low and really not part of the dialogue. It was the individual mandate where all the action was. So the auditing arm of the government that audited the IRS issued out a report earlier this year indicating that the IRS now has a process in place to start issuing out these 226 notices for the 2016 year. And we just got word that they've just come out. Employers are getting the 2016 letters. Now, since November of last year, employers have been getting the 226J notices for the 2015 year, and that had been, kind of coming in waves since November of last year. Now we're also seeing 2016 notices as well. The IRS uses this ECE system as well as other data points to determine which employers are in compliance and which ones are not. And what is somewhat new is that the IRS is now beginning to audit these non-compliant organizations on the quote highest value of work and not on a random basis. So the ones that are potentially subject to higher penalties, those are the ones that they are really, that there's some priority in that. Now, the penalties that we've seen for the 2015 year, the IRS identified roughly 50,000 ALEs as ACA non-compliant. And that was for 2015 and the 2015 reporting year, and 4.4 billion in total ACA penalties were announced for the 2015 year alone. And we have seen companies that come to us with these IRS letter 226J that have been in multi-millions. Now, mind you, we did not do the underlying reporting that got them in that situation, but we've been able to help them to respond to the IRS with these multi-million-dollar assessments. Next slide. Okay, so this presentation was prepared last week, and just earlier this week we found out that the 226J letters for 2016 reporting year have come out, and what the IRS is, as I mentioned, this is relatively new for the IRS since the employer mandate only started being effective in 2015. But the IRS is getting more efficient and also stricter in terms of compliance. The processes are improving, they're being more automated, and so they're just going to be more efficient and capture more purported non-compliant ALEs. And what we expect, another thing to note is that the penalty assessments are going to be higher than those levied by the IRS for the 2015 year. And I'll get into why, one of the reasons on why that's the case. And as I mentioned earlier, this highest value work. Okay, next slide. So what I'm going to talk about for the next few slides is to discuss the letter 226J, how the process goes, where we are in the process, what to expect, and as I alluded to earlier, why there might be higher penalty assessments for the 2016 year. Okay, so how does the IRS even come up with these letter 226J? Well, the way they gather data from these healthcare exchanges. The healthcare exchanges are basically whether it's healthcare.gov or like here in California, it's Covered California. These exchanges are the places or the healthcare marketplace where individuals can go and get coverage through the marketplace, and depending on their eligibility, which is driven by income and household size, they will get what's called a premium tax credit through one of these exchanges. And what happens is the exchange sends a list of who received these premium tax credits to the IRS. The IRS compares the PTC recipient data against the ALE's 1094 and 1095C schedules, and then out pops the number and who received the PTC, who didn't, and the basis for figuring out how to assess the penalty. Now, who is at the greatest risk in terms of which employers? Well, what we've seen is that employers with hourly workforces and high turnover are the most susceptible to having employees getting PTCs. And so those employers are the ones that are at the greatest risk. But certainly, even if you don't have an hourly workforce, you don't have high turnover, if you're not reporting properly, you're also at risk. So as we were talking about earlier, PTCs are what triggers liability. The A penalty, just one full-time employee has to get one. And then the B penalty, it's triggered on a per PTC employee basis. And that's what the IRS uses to figure out who's compliant, who's not, and what the penalty is. Okay, so we have our first poll question here. And it's, are you concerned that your organization may be at risk of receiving an ACA penalty from the IRS? Now I'm going to turn it over to HR.com to process the poll.
Okay, if everybody could please make your selections, and we'll give it a few seconds here, half a minute or so. And I'm going to close the poll in about 5 seconds. Give you just another few here. And closing it now. And now I'm going to share the results.
Well, that's good to see. I see that 55% of you are not concerned, and I take that it is because you have your ACA reporting in place. But there's another 45% where you are concerned or you're not, you don't know. And I'm hopeful that this presentation would be helpful towards getting more clarity in terms of what your risk would be and what you might be able to do to minimize that risk. Okay, so let's go to the next slide. You go to the next slide? Okay. So one step that I did not mention, and the IRS, which doesn't handle the exchange notices, and we've seen really some spotty processing at the exchange level, we're seeing it come back. The exchange notice is supposed to be a precursor to that letter 226J. So I talked earlier about how individuals would go on the exchange and get a PTC. What the process is supposed to be is the exchange is supposed to send the employer a notice that one of their employees or some of their employees had received a PTC, and basically affording an opportunity to the employer to dispute it if that should not be the case. Now, mind you, an employee who received an offer of employer-sponsored coverage that met certain standards, specifically minimum value and affordability, would not be entitled to a premium tax credit. But these, when an individual applies for premium tax credits, what we've seen is it's just basically a form, and they could fill it out wrong. And if they filled it out wrong, where an employer did in fact offer proper coverage, they still might check the wrong box and say, I didn't get coverage or whatever. So the exchange notice process affords the employer an opportunity to sort of remedy that issue before the healthcare exchange sends word to the IRS saying, hey, these people got a PTC. So another thing to note on the exchange notice is it's a 90-day process, so you have 90 days to respond from the date of the letter. It's a very time-sensitive issue, and the exchanges are getting more efficient on that as well. Because again, it's a new process, and they're trying to streamline it. But what we've seen for the 2015 year is that the IRS, in fact, just kind of skipped that. Employers got 226J notices without any exchange notice process beforehand. Okay, next slide. Now, as I had mentioned, there's that 90-day, and there's two ways to respond. And what we're seeing now is a lot of these sort of precursor exchange notices prior to the 226J. You can appeal the notice by submitting the proper documentation supporting a dispute. If you say, hey, this person should not have gotten a PTC because this person, in fact, received an offer of coverage and a minimum value and it was affordable. You could also ignore the notice and wait until you receive the 226J, which may contain this, A or B penalty based on the claim. Now, when you're preparing the exchange notice, if you're going to dispute it, you're going to want the supporting documentation. There are a number of defenses to it, And the things that you're going to want to have in mind and have documentation for: non-full-time status, or if that person was a limited non-assessment period, if you are using the look-back measurement, the calculations that back it up to show that person is not full-time, that the coverage met minimum value, the calculations of why the affordability was met. Okay, so the PTC listed employees, this is the one that in the IRS 226J letter will show, it's on form 14765, which is attached to the letter 226J, and it'll be called premium tax credit listing. These are the people that the IRS has identified are individuals who received a PTC and who presumably identified you as the employer. And so what the IRS does in the 226J, and that we've seen for the 2015 year, the IRS certifies under 1411 of the ACA that for at least 1 month of the year, one or more of the employees was enrolled in a qualified plan for which PTC was allowed. And so that means that that individual indicated was either not offered coverage or offered coverage, but it didn't meet minimum value or affordability. Okay, next slide. Okay, so this is our second poll question. And the question is, how are you documenting the offers of coverage you extend to your full-time workforce? So I'm going to have HR.com process this.
Okay, the poll is open. And we set this one up as a multiple choice, so if you have more than one selection, you can do that. And this is great. The votes are coming in nice and steady. And we'll give it about 10 seconds more. And I'm going to end the poll and share the results.
So it looks like there's about 40% of you where you are documenting it through invoices, waivers, and enrollment forms. It looks like less than 10% is not documenting the offers, but the vast majority, well, the significant percentage of you, 40%, is they're tracking it through forms. And what I wanted to mention on that is, you know, as I said, we've seen 2015 IRS 226J letters come out a few months ago. Now we're seeing 2016 letters. And the point I really want to emphasize here is that that's from 3 years ago. Are these medical invoices, waivers, and enrollment forms complete and in a centralized location? Are all the documents together and somebody who understands where what all that information is and that it's complete? Now, one of the issues that we've seen with responding to the IRS 226J is that the documentation is not complete, and you know, if there's turnover in the HR department, that also creates issues as to where it is and what the forms mean, and then of course to understand that it's complete. Now, it's better to, you know, paper forms, if you're going to have them, if you can scan them and put them all in one place so that it's sort of saved for posterity. What we've seen that really is kind of a gold standard is the sort of acknowledgement of offer system done on an electronic basis. So that way you have it in a central location, you know whether it's complete or not, and it's readily accessible. Now, you're going to need that information, because if you get the IRS 226J letter, and let's say you're trying to show that you made the offer of coverage, you've met minimum value or whatever, that you've met those standards, how are you going to prove that? And so having all this documentation is really crucial to that. And the issues with like just having medical invoices, for example, they only show who enrolled, and the touchstone of the employer mandate and the ACA is it's about an offer. It's not about whether the employee actually accepted the offer. It's whether or not that person was actually given an offer. And so the key is to track who was offered. And the medical invoices would only show who actually accepted it, i.e. enrolled. Okay, next slide. Now, what we've seen in terms of the sort of volume of individuals who've actually gotten PTCs is pretty significant. We had thought it would be a lot smaller, but it turns out that a lot of people were able to obtain a PTC. Now, to be eligible, the individual has to be between 100% to 400% of the federal poverty line. And I'm going to show you the chart of that. You can see if you're in a household of 4, for the employer mandate PTC eligibility, you could make up to $100,000 for your family. So it's, there's this sort of notion that you have to be super low income. That's not the case. $100,000 is, above the median income that we see. And so, for a smaller size, but for a family of 4, to hit 400% of the FPL is a pretty sizable income. So what you're looking at is the 100% to 400%. This is the range of folks who would be eligible for a PTC. So those are the people who would be the ones that potentially trigger a PTC and thereby potentially trigger a penalty in the IRS 226J letter. Okay, now this is really kind of laying the groundwork for the IRS 226J notices for the 2016 year. It's the IRS 5699. And this letter really is just trying to discern who didn't file, but the IRS had some inkling to believe that they should have filed. Now, keep in mind, the IRS has the W-2 counts, based on W-2 reporting, which is, a longstanding reporting requirement. And so what the IRS has done is sent out these letters basically saying, let us know if you are an ALE and when you're going to file, essentially. And if you're not an ALE, why? So, responding to that, obviously, if you're below the 50 full-time equivalent threshold, you can, respond to that letter by explaining that. But if you are above it and you didn't report, they're expecting you to identify when you are going to report, and if you did report, when you reported. So, getting this letter is that you've sort of been on the IRS's radar that you will be getting a letter, and this is particularly important for those employees who have not filed. Now, obviously, if you've already filed and the IRS is aware of that, you're not going to get a 5699, and if there's some potential penalty to be assessed, the IRS is just going to go straight to the 226J notice. Next slide. Okay, so this is our third poll question. And so the question is, what is your biggest concern about responding to a letter 226J notice for the 2016 reporting year? Has the poll started?
It sure has, and the results are coming in.
Oh, great.
There's a lot of choices, so I'll give it a little bit longer this time. About half of you have voted, so let's get some more votes in there. Okay, I'm going to give it another 5 seconds or so. So last minute voters. We're going to close the poll in 5, 4, 3, 2, 1. And now sharing the results.
Now, it's kind of interesting. The results are kind of all over the map, with the largest being I don't know. And so hopefully, we can cover sort of all the different bases and provide some guidance in that. But as I said, they're really all over the map, with the largest percentage being I don't know. Okay. Now, so what's inside the letter 226J? Now, it's the notification by the IRS that at least one employee got a PTC, and the name of that at least one employee. And this really could be a scary dollar amount. Identified on the first page is that employer share responsibility payment. That's what the IRS is proposing that you pay. And what you'll see is typically on the second or third page, you'll see this ESRP summary table. And it spells out how the IRS calculated the ESRP for each month based on the 1094C and 1095C schedules. And it's going to be important for you to cross-reference those schedules, because we have certainly seen that there has been errors in that. Okay, next slide. Now, I had alluded to this fairly early on, but didn't get into it. And so here's this higher penalty assessment for 2016 than 2015. Now, 2015 was the first year, and it was like chock full of transition relief. And one of the transition relief was this lowered threshold, where instead of offering at least 95% coverage for full-time employees and dependents, the requirement was 70%. So it was a much lower threshold. So if you offered, say, 90% in 2015, you would have avoided the A penalty. But in the for the B penalty, you would not. You might have had some. But in 2016, if you only offered coverage to 90%, you would be tagged with the A penalty. It's kind of a cliff, that 95%. Substantial compliance isn't enough. So here's an example. So suppose you had 500 full-time employees, and you offered employer-sponsored coverage, which, the word minimum essential coverage is, you'll see that a lot, but really an example of that is just employer-sponsored group coverage. So if the ALE offered coverage to 400 full-time employees, and at least 80% of the and at least 80% of its full-time employees, you would be within that 70% offer rate, right? So you offer to 400 employees, that is 80% of 500 full-time employees. So it's well within the 70%. And let's suppose one employee obtained a PTC. Well, because that threshold is met, the IRS would not assess any A penalty. Now, the B penalty is assessed for every full-time employee who receives a PTC, right? So, where that person didn't get an offer of coverage or received an offer, but it wasn't affordable or didn't provide minimum value or both. So because it's a one employee for 2015, the B penalty is $3,120, so about $3,000. Now, let's fast forward 1 year to 2016. That offer rate requirement jumped from 70% to 95%. So same deal. The ALE out of those 500 employees offered employer-sponsored coverage to 400 employees, or 80%. That means the ALE has not met that 95% offer rate. And so the penalty that's going to be assessed is this A penalty. And so that A penalty is assessed for each of the 500 full-time employees. It's not just for the ones who didn't get it. It's all of them. And so you take that 500 employees minus the 30 freebies. So it's 470 employees that you're going to be assessed that A penalty, which is roughly $2,000 for the year. And the total amount that you would be assessed is over $1 million. For the same offer of coverage, when you did it in 2015, you only got a penalty of $3,000. In 2016, that penalty jacked up to now over $1 million. That's what I mean by higher assessment. It's that threshold going from a 70% requirement to a 95% requirement. And those are cliffs. 94% isn't going to cut it. Okay, next slide. So when you get the letter 226J, what they'll give you is this form 14764. That's the response, and it's a fairly simple form. And it says you can either agree, like I mentioned that example of the over 1 million payment. You can agree and you can enclose that payment. You can also either totally or partially disagree with this employer statement explaining the disagreement. You could do nothing, and then the IRS will follow up with a notice and demand of payment. That third option is a bad option, because that option, they will then start the collections process, and that creates more penalties. Now, what we're going to talk about is about the totally or partially disagree, where the IRS letter 226J proposes a penalty, and you are able to dispute that amount either in full or in part. Now, typically these IRS 226J letters say you have 30 days to respond. We've certainly seen the IRS being willing to give extensions, but they're typically around an additional 30 days. So this is not something you can just sit on your hands and, procrastinate. Next slide. Okay, so if you are going to dispute that amount, like the example I gave you on the 2016, that's an over $1 million penalty, you could just pay it, right? If you are going to dispute that amount, at least in part or in total, you will need to provide an employer statement that you sign. And so what that statement is going to explain is what the amount should be. Could be zero, if that's what you're saying it should be, and then explain why. And what does why mean? Well, if that may include describing the methodology, the calculations, the code corrections, or whatever it is, it's your basis as to why that amount is not correct. And then you want to provide or indicate availability, depending on the circumstances, of the documentation that supports that why. And some IRS agents indicate that the documentation is not needed. They just want you to explain it, articulate it, and sign your statement. But it's always good practice. If you're not going to include the specific documentation, you could say that it's available, so that if for whatever reason the IRS rejects your response, you can back up why you're right. Okay, next slide. So what kind of documentation are we talking about? What kind of calculation are we talking about? So let's say that your basis is how the full-time status, like you have less full-time status than full-time employees than what the IRS indicated on their IRS letter 226J. So you're going to want to show why the FT employees, full-time employees that you have is less than what the IRS identified. And it could be that your schedules, the 1094, 1095 schedules you originally submitted, were done wrong. It could be that it was done right, but the IRS just, for whatever reason, put the wrong number in. Typically, they do match what was reported in the 1094, 1095C. So this may be a need to correct those schedules. And so, so you're going to want to get that documentation together in the calculation for the FT status, if that's the basis of your challenge. And then what if you're trying to make code corrections, you're going to need to explain why you are making the code correction. So let's say that in the 1095C schedule, you had put 1H on the line 14, which means no offer of coverage. But in fact, the person did get an offer of coverage, so that code correction was wrong. So you're going to want to explain the code corrections, and they'll give you this form 14765, which allows you to make corrections to the form. And then in your employer statement, you're going to want to explain and justify those corrections. And so we were talking about documentation. And so these are the kind of things you're going to want to have readily available. So if you're challenging the IRS's 226J letter with regard to the coverage not being minimum essential coverage, we kind of use that sort of terminology, which is really a healthcare plan, a group healthcare plan, or minimum value. The summary of benefits coverage is a good one. Your carrier is supposed to provide that to you. And that will say on one of the pages, they'll give you a statement that it met minimum essential coverage and minimum value. So that's one thing you can always point to if the challenge is on minimum essential coverage and minimum value. When it comes to affordability, if you want to show that it was in fact affordable, and that's the issue, like whether it's from a code correction or why that person wasn't eligible for PTC, et cetera. One of the things we've seen are like rate sheets. Now, employers, depending on size, you might have a composite rate, which is kind of a uniform rate for everyone, or you could have individualized rates. But having these rate sheets that for the pertinent time frame, that's a good way to establish what the actual whether affordability was met. And then the offer of coverage. We had talked about in one of the poll questions, how are you documenting your offer of coverage? The largest number of you had talked about sort of medical invoices, waivers, enrollment, and I already talked about that. But that's going to help show that you met that 95% threshold. So, if you only have a medical invoice documentation for 90% of them, that's not going to be enough. You're going to want to cover all of the at least 95% of the full-time workforce. And as I mentioned, whether you submit the documentation or not, your employer statement should just be confident that you got it. And if the IRS wants to look at it, you're going to make it readily accessible to them. Next slide. Okay, so we were talking about that. And so if you disagree, what kind of errors should you look for? The wrong FT count, as I mentioned, that's where the A penalty is really going to be a big issue. Did you apply the monthly measurement method? Did you use the look back method? And if you did, were they done correctly? So you may want to make corrections to them, and that may reduce your full-time code. With regard to coding errors, I kind of alluded to that one, the 1H and line 14. So the coding errors typically are on line 14 and 16 of the 1095C schedules. And there are various combinations, the 1 series and the 2 series. And many of the 2 series have like safe harbors where you're saying it was affordable or in different types of affordability. These are all the codes that you're going to want in the IRS 1095 instructions. It explains exactly what each code is and what it's for. So you're going to want to look at your 1095C schedules to make sure that that's what's identified in the 14765 form. And even if it was correctly reported in the 14765 form, the question is, did you report it correctly in the 1095B? And making these corrections could also eliminate or reduce the B penalty. Next slide. Okay, so I mentioned if you don't respond, the IRS is going to issue a notice in demand. That it's a different process. The collections process is not trivial. You could get subject to liens, levy enforcement actions, and interest will accrue. And that could be substantial. Okay, next slide. Okay, so what can you do now to minimize your organization's potential penalty risk with regard to the 2016 year? Well, one, you could just check right now, figure out, well, let me look at my 1094C schedules, let me look at my 1095C schedules, and let me figure that out myself. Let me do what the IRS is going to do in advance. And then look at the forms itself. And if there are errors in there, check them, correct them, be proactive. And then also you can use that to create a process for better compliance for future years. So that's what you can do. And our company does spot check edits for free. So just FYI, but this is something you should do. Okay, so our next poll question. What part of the ACA can be most time consuming for your staff? We could have HR.com start the polling.
Okay, I've launched the poll. And we're getting a lot of results coming in already. Give it another 10 seconds or so. And I will close the poll and share the results.
We got a clear winner here. We got 49% saying cleaning and validating payroll data and benefits details. That's not at all surprising. Certainly in our experience, that has been a big pain because it's messy. People are inputting information about individuals, and people make mistakes, whether it's on a social security number or a comma in the wrong place. You have two Susie Smiths, whatever, and trying to make sure that you have sort of clean data per employee, for all the ACA information. That is definitely a huge issue that we've seen with clients in terms of doing the reporting. So that is something, it's a little bit, it's just kind of something that exists, but there are means to get the data clean and validated. And part of the sort of audit process that you should do in advance of getting a 226J letter is to, be proactive in putting in mechanisms to get that data clean, so that you can do the reporting for future years. If we could close the poll and we go to the next slide. So when we're talking about the potential risk exposure, that's that ESRP amount. And as I said, analyzing the previous years is 1094C and 1095C to verify the accuracy of the full-time count. You want to review the IRS code combination. This is actually a really good one that we've seen. Sometimes the 1095C schedule doesn't make sense. Like, for example, it says no offer of coverage, but it was affordable. Well, what was affordable about the no offer of coverage? It doesn't, or the person, received an offer of coverage, but that person wasn't employed there. Like, there's going to be some nonsensical coding that could have infected your 1095C form. So you want to look at the code combinations to make sure they make sense and accurate. Now, mind you, I talked about the 6721 and 6722 penalties. Those are the reporting penalties, not the actual failed offer coverage penalties. And those penalties are, also for inaccurate filing. So you want to be proactive in correcting those. So you submit, you review the data that was submitted in the filings and identify where there are any errors. And if the mistakes are evident, that's, some are easier than others, you can correct them and also, indicate to the IRS that you have the documentation to back up your corrections. Next one. Okay. So as I had indicated, being proactive is really important. Is you're basically preventing the letter 226J from coming. So, and also gives you more time to just address the issue before you get the 226J, which starts the clock. Next slide. Okay. So, we were talking a lot about this letter 226J and the sort of the penalties. And underlying that really is an opportunity for you to review your current ACA compliance process and determine, well, should we change that? Should we make it better? Also educating your staff who are handling ACA compliance on who's responsible for what. Creating more efficient processes to extend offer coverage, how you're structuring benefits, proper implementation of the monthly measurement method or look back, depending on which one you're applying, the affordability determination and tracking offers of coverage. Again, that 95% cliff, that's very important. And if you make these improvements to your current process, you will reduce the risk of future letter 226J. And if you get one, you would reduce the risk of a larger penalty. So that concludes our presentation, but we wanted to allow for some room for questions. Okay. One thing I really didn't get into, but it came out of a polling question, was the data cleansing. There are outside vendors that can help you clean your data. I mean, we are a company that does that. It can be painful if you're trying to do reporting when your data is not clean. It is extremely important. So just be aware that there are outfits that can take care of that for you. So I just want to ask HR.com, are there any questions?
Yes, Joanna, there's about 8 to 10 questions here right now. So I'll start from the beginning, I guess. Will employers always receive a notice that an employee applied for coverage through the marketplace and received a tax credit?
Unfortunately, the answer is no. It should be that they receive it, because the way that the ACA employer mandate was designed and spelled out in the statute, it says that the exchange will send you a notice. It's not may send a notice, you will get one, but the reality is we haven't seen one. And if you want to challenge the IRS, at the 226J letter, that's going to be very costly. So the IRS 226J letter is in some respects a second bite at the apple. You get the exchange notice and you can dispute it within the 90 days. And if the exchange doesn't agree with you for whatever reason, then that person, the exchange will send the IRS notice of that person's PTC. So then the IRS then gives you another bite at the apple to go through and identify that person who got the PTC shouldn't have got one. So in some respects it's a second bite of the apple, but it's always nice to just deal with it at the exchange level, so they aren't sending notices to the IRS that the 226J letter is coming. But we have seen the IRS skip it altogether and say in the IRS 226J notice saying, hey, this is your notice. Next question.
Okay, what if a client has prompted the appeal request with the health insurance marketplace? Can the appeal request be withdrawn to wait for the IRS letter? Please confirm.
Well, you can say you're going to just wait. I mean, you can, there's nothing prohibiting you from, withdrawing your request. But certainly, if you withdraw the request, that notice, in theory, should go to the IRS at that point.
Okay, next question here. What action does the IRS take against an employee who improperly received a PTC?
Well, in theory, the IRS can claw back that credit through the 1040, income tax returns. Basically, if an employee erroneously claimed whatever he or she claimed to get the PTC, and it's been established that that wasn't proper. That person shouldn't have gotten the PTC. That should come out of that person's, that would be resolved at that individual's tax return.
Okay. How are extensions requested? Please confirm.
With the process that we've seen, we've dealt with the Kentucky office and the Utah office. Those seem to be the primary originators of the 226J letters. And, there is no official process. But like the way we always handle it is if we speak to somebody, we would always send a confirming letter memorializing the extension. It's always nice to document that, if you spoke with an IRS agent, and they're like, yeah, sure, go ahead and get another 30 days. For your own peace of mind, you're going to want to send a follow-up letter saying, dear Mr. or Ms. So-and-so, I didn't get their agent number, etc. And say, on such and such date put your tax ID number, etc., confirming that that you got an extension and the new deadline is whatever the deadline is. That's probably the best process. Whatever agreement, whatever extension you get, if it's verbal, you're going to want to put that in writing. Next question.
Okay. So does this mean that the IRS may accept my explanation without looking at my supporting documentation?
Yes. But if your letter says, dear IRS, we are compliant, thank you very much, probably not going to be accepted. What the IRS, think of it this way. If you very detailed, factually explain why you met whatever the requirement was, and you indicate to the IRS that the documentation is available for IRS review. I talked earlier about the sort of highest value work. What would be the point for the IRS? Like, okay, they're going to be able to prove this. So you don't have to provide the documentation, but you're going to want it just in case.
Okay, we've got lots of questions still coming in. So here is one. I received a letter from Covered California where it specifies employees who are enrolled in their coverage. It says we have to share responsibility, but I have the waiver on my end. How can I appeal? What's the correct process for this?
Well, if Covered California sent you a notice, that's that exchange notice. On it should identify what the process is, which is typically going to be 90 days to respond. So you're going to want to respond in writing back saying, this individual, erroneously, intentionally, whatever, that this individual was not entitled to a PTC because this individual had received an offer. See attached waiver, and you want to make sure that waiver of offer of coverage identifies what was offered, i.e., that it was affordable, met minimum value, etc., and that it covered the whatever the reporting year at issue is. So if the exchange notice says, hey, Susie Smith got a PTC for all 12 months of 2016, and you would want the waiver form that shows that all months of 2015 that she had declined that offer of coverage. And again, they should be saying you got 90 days to respond. You're going to want to respond within that time frame and in writing. Maybe one last question.
Here's a really quick one, and then I'll ask one more. So this should be yes and no. How long does the backup need to be kept? 7-year rule?
Well, that's always a good rule. That's a question.
Okay.
One caveat on that. There is no statute of limitations of the IRS if you didn't file. The statute of limitations starts to run after the date of filing. So if, let's say for 2015, you didn't file the 1094, 1095C schedule, that could come back to haunt you many years later.
Mm-hmm. Okay, last question, and we'll get to the rest. We'll send you answers via email. So the last question I'm asking is, if we know of errors that occurred in 2015, 2016, should we go ahead and correct now and send corrections?
Yes, the IRS has indicated they want you to, as soon as you're aware of the corrections, you should promptly correct.
All right, and we are at the top of the hour. So if you'd like to wrap it up.
Yeah, and if you have other questions, through the HR.com process, we're going to upload and provide answers to all of the questions. So you'll have that, you can get your questions answered that way. Anyway, I hope this was helpful, and thank you very much for your time.
And on behalf of HR.com, we'd really like to thank our sponsor today, First Capital Consulting, and Joanna Kim Brunetti for this very informative webcast. Lots of information, a lot to absorb. This concludes our webcast. And if you'd like to view this webcast again, the archive recording and slides will be available for up to 7 days for our free members. And if you have a recertification membership or an HR Genius membership, you have unlimited access. Your webcast credit will show up in your HR.com account within 2 business days. We will also send you an email with the credit information. As I mentioned, the questions that we didn't get to, or if you think of any further questions, indicate them in the exit survey, and we will be passing all the questions on to Joanna, and they will be reaching out to you with those answers. Your feedback is important to us. Please take a moment to fill out the exit survey that opened in a new browser page on your computer, or click on the link to the survey in the chat area of your webcast controls. This concludes our webcast. Enjoy the rest of your day.